Good morning and welcome to The Street today, here from Post 35 on the floor of the New York Stock Exchange. It is Monday, February 6th. I'm Katherine Ross, filling in for JD Durkin. Stocks are trading lower with all three indices down as Wall Street comes off yet another week in the green and as investors prepare for yet another big week on Wall Street. On the show this morning, we'll talk earnings as investors gear up for the latest batch of quarterly results. Plus, we'll tell you what to expect from Powell ahead of the Fed chairman's speech this week. And finally, we'll tell you why Tesla is raising the price of its Model Y after slashing prices just last month. For more on these topics and others, let's welcome our senior editor and chief markets correspondent, Martin Baccardax. So as I said earlier, Martin, markets are trading lower with the NASDAQ really leading the decline. What's weighing on investor sentiment this morning?
I really think, Catherine, what we're looking at right now is a market that's driven by what's happening in bond yields. Essentially, Friday's blowout payroll report was really a wake-up call for quite a few investors, particularly those who were challenging the Fed's interest rate forecasting. You remember now for many weeks, the assumption had been that the Fed was going to get to 5% and hold there as a terminal Fed funds rate for most of 2023. Powell told us that last week. He said there's likely to be a couple more rate cuts, as he described it. But the market had been pushing back at that, and they've been pushing back on it for a number of months. And really what we saw on Friday was, because the employment gain was so significant, that investors began to feel that inflation was likely to follow suit. And we also had some PMI data on Friday that suggested services sector activity over the month of January, which is the biggest driver of U.S. GDP, was also off the charts. It was about 5 points above the mark that separates growth from contraction. So you put those two things together and everybody begins to be concerned that inflation is going to begin to re-accelerate into 2023. That ripped bond yields really, really quickly. We had two-year notes were trading as low as 4.1% prior to the data on Friday. They're now above 4.4%. And moving higher. 10-year note yields are topping 3.6%. And as a result, what we're seeing is investors having to reevaluate not only what they think about the Fed, but what they think about equity valuations as well. And if the valuations are getting stretched as a result of the bond market moves, then stocks are going to move inversely. That's exactly what we're seeing today.
Well, and it comes as we are having a stellar start to the year so far. I mean, January was just so strong. And we've got the broader market trading around its highest levels in 5 months. What would you say are some of the biggest factors driving optimism for investors right now?
Yeah, I think you hit the word correctly, Catherine. It is optimism. It's a sentiment-driven rally. And it's one that has perplexed a lot of people and therefore has really created a lot of doubt and suggestions that it's one of those bear market rallies, whether compared to something that's maybe a bit more sustainable in the long term. It really is hard to find something specific from which you can hang your hat on with all this. Of course, we've had, I suppose, firming economic data, but not to the degree that you would elicit a 15 or 16% gain for the S&P 500 from those October lows. We've had some downward movement in inflation, but nonetheless, the rate of change has been slowing over the past couple of readings and could indeed slow further. And the earnings season hasn't been particularly solid either. So it really is hard to describe. What I would think is happening, and this is just doing some back of the envelope arithmetic, is that you are getting some of the mega cap stocks, the Apples, the Metas, the Teslas, and the Amazons of the world outperforming, and as a result, lifting the broader indices because there's such heavyweights within it. And that is to some degree clouding the struggle that a lot of other companies are having underneath it. So you get almost a false positive. You get the S&P 500 rallying, but not on a broad set of strength, more on the weight of these mega cap tech stocks, and as a result, some FOMO momentum, which is driving this sentiment-driven rally.
Let's focus on the S&P 500 for a second, because it specifically has posted one of the largest volumes in the last year. Do you expect that to last? You sound a little bit negative.
Slightly negative, although not to the degree that I think we are in some sort of correction territory. I know that at least a couple of weeks ago, was the sort of cool kids trade, the assumption that this was absolutely a bear market rally that was going to give itself up in the coming weeks. I do think there is a headwind from the Fed that the market maybe fully hasn't priced in just yet, even though we have tailed off in the past couple of days. But my biggest focus, Catherine, I truly believe, is going to be what we are seeing with respect to earnings, not only forecasts, but the end result of the fourth quarter earnings season, which just hasn't been particularly great. I mean, we're looking halfway through. S&P 500 earnings are likely to fall about 3% from last year. And as a result, if you strip away the energy sector, which is obviously not reliable on a sequential basis, you're looking at a drop of about 7.7%. Now, forecasters suggest we're going to get a similar decline over the first 3 months of this year. So that gives you, in essence, an earnings recession of 2 consecutive quarters of contracting corporate profits. It will be very hard, I think, to sustain the kind of equity momentum that we have now if you have a contracting earnings scenario against more Fed tightening, or even a scenario where the Fed tightens as has promised and stays there until the end of the year. So I think that macro headwind, coupled with some probably earnings pessimism more than anything else, is why I'm not fully convinced of the sustainability of this rally. But it's absolutely a difficult one to fight against. I mean, the S&P 500 is up 4 of the 5 weeks so far this year. Again, as I mentioned, up about 16% from the October lows. And when you couple the S&P 500 with a nice 60-40 portfolio weighting with fixed income, the month of January was one of the strongest on record. So it's a difficult take to fight against, but I do have my questions.
Well, and it leads me to wonder, I was talking about this with Stephen Guilfoyle and Chris Versace last week, both of which are contributors to both our Action Alerts Plus and our Real Money websites. And one thing that we were discussing is whether or not we're seeing a bit of a bear or bull trap in this market. If you think that this rally isn't sustainable, would you concur on that? Do you think maybe we've got a trap set?
I do. I do think it is certainly possible, but I think a lot is going to depend on what sort of signals we are going to read from the tea leaves of the bond market, although that has become more difficult as a result of the mechanics there. The Fed, of course, is rolling off multiple billions of bonds every month as part of its quantitative tightening program. The government, of course, is ratcheting up borrowing, and we have the headwind of the potential sort of face-off from a political perspective on the debt ceiling. So the mechanics and the day-to-day trading that we see in treasuries might not be providing the precise signal that equity investors would typically rely upon. And therefore, it is going to be a lot more difficult, I think, to predict where we're headed in the short and indeed the near term. But I do think there is that bear trap potential in the sense that, again, it feels like this current rally has a sentiment driving factor more than a fundamental one. Although that said, the numbers that we saw on Friday, both in PMI data and the job market, do suggest there's some resilient strength there. And if the Fed can thread that needle, where it's able to tame inflation while avoiding recession and at least engineering a certain amount of growth, and of course execute the soft landing that we've all hoped for, then maybe that bear trap begins to dissipate and the rally has a little bit more strength.
Martin, we've seen months of headlines and various conversations surrounding a U.S. recession, but the job market is so strong. I mean, we're historically at a strong point. So does Friday's jobs report kind of dispel any fears that we're in the midst of a recession right now?
It's a lot more difficult to find recession clues today, Catherine, than it was even a week, a month, and certainly 2 or 3 months ago. The job market is a curious one, though, because it really is setting off so many mixed signals. Obviously, that January payroll number was off the charts. Now, my suspicion is it is absolutely going to be revised when we get the data for the month of February. But nonetheless, we're looking at a headline unemployment rate of 3.4%, and that's the lowest we've been since 1969. But set against that, it's really interesting because you would imagine an economy that's adding 500,000 new jobs is going to see wage acceleration, but we're just not getting it. Month-on-month wages were only up about 0.3%, and that was right where the market thought. The employment cost index for the final 3 months of last year was up less than expected at just 1.1%. And curiously, what we are also seeing at the same time, Catherine, and of course we've seen the headlines almost every day, is the tech sector is shedding people by the thousands. Dell Technologies only this morning said as much. And the Challenger Gray Christmas report on layoffs in any particular month showed we had about 190% increase in January layoffs compared to this same time last year. So there's weakness in some sectors, strength in others, and therefore it makes it extremely difficult to understand exactly where the labor market sits. It's hard to imagine we could add that many jobs, but only have tame wage growth. So maybe, just maybe, we're seeing some of those people come off the sidelines into the job market, but not being as demanding with pay as they normally would be. And again, that's probably the kind of soft landing material that the Fed is hoping for.
Pulling out of the jobs market and just looking at the broader economic data that we've received, what are some of the main factors that you pay attention to when it comes to recession indicators?
I think PMI data is certainly one that we should all be a lot more cognizant of because it has such a correlation with corporate profitability and then as a result, stock performance. So that's a number, particularly in the United States, that I do tend to cling to. It is, again, a sentiment-based survey, and it's not actually fundamentally sort of constructed in terms of real and actual data. It's more about reporting data, and therefore, as a result, it can be influenced by all sorts of things. But nonetheless, it has a very good track record for giving us an understanding about activity, certainly in manufacturing and also in services, which, again, as mentioned, is really the most important driver of growth. So I'm certainly looking at those. I see them in a different context than the similar numbers that you see in Europe and Asia because the data sets there are quite young. Here in the United States, we have two with both the ISM and the S&P Global PMI data. When you put them together, you can get a far more accurate reflection of the kind of activity we're seeing. But what many people are saying, Catherine, is that the two most important components in recession avoidance right now are the housing market and the consumer. We'll start with the housing market. Have we rolled over? Are we looking at the pit of pricing and activity, which of course waned significantly into the end of last year as mortgage rates shot up? Or is there another leg down? That will be critical in terms of our understanding about broader economic strength. And the consumer may end up being the most important component because we have to understand whether that pandemic era savings has been run down completely and people are then going to start dipping into their credit cards in order to carry on the spending levels that they had sort of executed over the final 6 months of last year. And whether the unemployment rate that we see at these historic lows is going to be maintained or if companies are going to be able to shed more workers going forward if they see economic weakness in the windscreen. So for me, those are probably the two most important components. So when we look at consumer spending, we want to look at the Michigan Consumer Sentiment data, which we'll get on Friday, retail sales, which we'll get into the coming weeks. And then, of course, from the housing market, we have to look at starts, mortgage rates, and indeed sort of existing home sales to get that better understanding going into 2023.
Now, Martin, we kind of lightly hit on earnings, but I want to dig deeper here with this earnings palooza continuing. 92 S&P 500 companies reporting this week. What are some of the biggest names to look out for?
I think the most interesting one this week, Catherine, is probably going to be Disney. We'll get that on, I think it's, looking at my schedule, Wednesday afternoon after the bell. And of course, we want to understand to what degree that company is changing its tact from simply trying to amass subscribers at any cost to pivoting towards a little bit of a company that's a bit more sort of cost conscious and as a result wants to be more profitable. We've seen echoes of that in the tech sector, most specifically from Meta last week, which was significantly rewarded by investors for changing the nature of its business from one that was growth at all costs to a more mature company that was conscious about costs and indeed shedding employees at the same time. It's a bit of a grim assessment, but that tends to be how the markets perform their arithmetic with respect to this. So Disney will be one. CVS Health will be another. That's an interesting company from a couple of perspectives. Obviously, it gives us a sense of consumer spending at that sort of pharmacy level, but also because of its reliance on Aetna to drive both its revenues and its earnings, we would like to understand a little bit more about how Medicare's attempt to claw back some overpayments is going to affect their bottom line in the coming years. Medicare is going to be very aggressive in trying to claw back a lot of this cash. It's spread over a number of years, so it's not something I think that's going to be imminently negative for CVS. But nonetheless, I'll be interested to hear how they articulate that. Uber Technologies is another one. People heading back to work, but not on a 5-day basis. But yet at the same time, they're probably out a lot more. Everything that we hear from the restaurant sector suggests that it's booming right now. That's obviously very good for Uber. So their forecasts for near-term profit and full-year profit will be very interesting as well.
You mentioned Meta being rewarded by investors after last week, but I mean, when you look at tech in general, there's not much rewarding going on. And especially Apple, we were talking about it before we came on the live show today about how investors are coming back in to hit the sell button with that name. So do you expect 2023 to be a brutal year for the tech sector?
I think it's going to be a separating year for the tech sector, Katherine, to be perfectly honest. I think what we're going to see is investors being a little bit more selective in terms of the tech companies that they choose to back. I think the days of simply assuming that hypergrowth can continue ad infinitum are absolutely gone. And that's why investors are now more focused on what companies are saying with respect to their cost base than they ever have been before. I do truly believe Apple is kind of an isolated case simply because it has been so transparent about what it anticipated over the December quarter that investors were prepared to sort of reward them for that on Friday. And by that, I mean, Apple told us in November that supply chain disruptions in China were going to keep iPhones off the shelves in December, but they assumed that demand would pick up those sales, which would be delayed into March. And that's virtually what happened. We had lighter than expected December revenues, but Apple assured us that they expected all of that to come back in the 3 months that end in March. So the stock was bought back on Friday. I should imagine today's decline is more linked to what we're seeing in treasuries than anything else. But to your larger question, I think it is going to be one of those years of separation where the quality tech companies that are in mature markets and are holding costs together and maybe even reducing CapEx are going to be the outperformers compared to the companies that we have just been betting on growth that hasn't quite materialized yet. And betting on that growth in a rising interest rate environment simply doesn't pay off. So I can understand why there's going to be a lot of underperformance in the tech sector while the big names begin to separate themselves.
Over half of the S&P 500 companies have now reported earnings. What's your overall outlook on fourth quarter earnings season? I think you've touched on it, but let's dig into it a bit.
Yeah, I think it's worth digging into because we are looking at that decline when we compare it to the final 3 months of 2021 of about 3%, strip away the energy sector, and it's a decline of about 8%. But what's even more interesting underneath that, Katherine, is that the rate at which companies are beating earnings estimates is virtually at the same level as the long-term average, somewhere in the region of 66 to 67%, depending on who you take your data from. But the level at which they're beating is very, very small. Typically, companies are beating forecasts by between 5 and 10%. This time around, they're beating them by between about 1 to 1.5%. So only very narrowly, and only very narrowly against already reduced forecasts. So profitability simply isn't there, at least at the moment. And that's why I think to some degree you're seeing so many layoff announcements, which are coming parallel to earnings or even prior to earnings, and why you're seeing investors so focused on that cost-cutting focus, because ultimately, if profit margins are going to be maintained in a declining environment, the only thing you can do is take away costs. Unfortunately, for a lot of companies, that means taking away headcount, but it can also mean pulling back on CapEx and investment opportunities at the same time. So when you throw all that together, I really do think that you have, whilst not a terrible earnings season, certainly not one that has topped expectations to a degree that would again validate the kind of rally that we're seeing, or at least prior to Friday, in the S&P 500.
Let's move on to looking at the week ahead, because obviously earnings play a huge part, but we also have Federal Reserve Chairman Jerome Powell set to take the stage in Washington on Tuesday. How crucial is the speech?
I think this one is enormous, Katherine, and it's really interesting that it comes Tuesday around midday because it is going to be a live market against Mr. Powell's Q&A at the Economic Club of Washington. And really, this will be his first opportunity to speak, obviously after last week's rate increase, but after the Friday payroll data. Now, here's where he might find himself caught in a bit of a trap, however, because he did mention disinflation and deflation a number of times in his remarks to reporters after the Wednesday press conference. And in fact, he didn't push against the market's assumption that the Fed might even entertain the idea of rate cuts in the back half of the year. He said that they weren't, but he didn't push against the market expectation that they were. Now, of course, we had the payroll data on Friday and the PMI data as well, both of which prima facie suggest faster inflation. So now Powell is left with one of two choices. He either has to push back against those market expectations with great force, which would, of course, induce a really hawkish tone from his question and answer session, or he is going to have to maybe hint towards the fact that the Fed is closer to engineering the soft landing than perhaps they were before, and he isn't worried that inflation is going to accelerate along with the job gains. He may not be able to do one or the other, though, and have to find some route in the middle. But either way, stocks, bonds, and everybody else are going to be incredibly sensitive to what he has to say. So I expect a lot of fireworks on Tuesday, no question about it. Do not go out for lunch that day. We definitely advise you to bring some food into the desk, and we'll all watch it together.
Maybe we'll have to Uber Eats it. But Martin, do you think that we're going to, it kind of sounds like we're going to hear a different tone from Powell on Wednesday. Do you agree with that assessment?
I think we'll have to. I really, really do. I think that he has grown, I wouldn't say frustrated, but maybe just a little bit. He's found his conversations with reporters and with the markets a bit tedious because he has been so singular with his messaging really since the summertime. He is saying, listen, we are not convinced that inflation is returning to our 2% target with the pace that we would like. And as a result, we are going to have to take Fed rates higher. We're going to have to take them very likely above 5% and stay there until the end of the year. And again, the market just wasn't buying that. They had been pricing in rate cuts in the back half of the year. And prior to Friday, they had been pricing in a Fed funds rate that would top out below 5%. Now, those bets have changed. Now, all of a sudden, the bond market is back in line with what the chairman has been saying, and they are pricing in a Fed funds rate over 5% and no rate cuts at all. So will Mr. Powell take a victory lap? Will he push further against the sort of market assumption that the Fed might take its foot off the gas? Or will he warn maybe even further that inflationary dynamics are still dangerous given the resilience of the labor market? And the labor market is something, particularly with wages, that the Fed chair has focused on for a number of months now. So I do think he'll have to change his tone. What might be more interesting is to where he decides to focus. Will he talk housing? Will he talk wages? Will he talk jobs? Or will he talk a collective? And maybe on top of that, will he push back against market expectations?
Let's turn our attention to Tesla now, because it did raise the price of its Model Y after U.S. government adjusted its EV tax credit rules. How is this impacting the stock?
They really seem to like it this morning. I mean, it's an outperformer compared to some of the other mega cap stocks, even with the rising treasury yields. So I think investors are maybe wondering whether or not this will add at least some upward movement to profit margins if Tesla is able to execute price hikes in the coming months. Of course, we're not long from the time when Tesla was slashing prices in order to make sure that it was engendering enough demand. But now, because of a couple of things, certainly record bookings, according to Elon Musk, over the month of January, but also this tweak in tax credit valuations. Essentially, prior to Friday, the Treasury was essentially saying that cars over $55,000 would not qualify for that $7,500 tax rebate. Now, they tweaked it a bit on Friday, saying that certain vehicles, SUV crossovers, for example, the Model Y fits into that category, could be priced as high as $80,000 and still qualify. Now, this is important for Tesla because what they can do is not only raise prices for the base model, but they can also entice buyers to put further add-ons, either for software or for component parts or all sorts of other things, and still come in under that 80,000 threshold. So it's almost a perfect dovetail for Tesla in that they can drive prices higher and still generate subsidiary revenue on top of a particular unit sale. And this was something that Mr. Musk had sort of cottoned on in his investor call after the fourth quarter earnings at the latter part of last month. He said it was a business model that maybe people didn't appreciate, in that they could sell a unit and then continue generating revenue from it with software upgrades and different add-ons. So I think investors are looking at that potential alongside the fact that they have a wider window to play with because of the tweaking in the tax credit change. And as a result, they're pricing the stock up.
Well, and the stock is up around 70% year to date. Do you think that all of this adds to Tesla making a turning point?
That's a tough one. I think for some, it was simply just undervalued. Like, it had gone through such a decline over the period between sort of April, when Musk made his intentions for Twitter known, right up until the end of the December, when they were suffering from production outages in Shanghai as a result of the COVID crisis there. So the stock was just so beaten down and trading at a multiple that made it a lot more attractive, that I think you found a lot of investors piling into it in the month of January. I do think there are still significant headwinds for this company. I think the capital expenditures required to get Berlin and Austin up and running to the degree that Musk would like will require quite a bit of cash. I think that Shanghai is still a wild card with regards to the COVID situation there. And of course, consumer demand in China is difficult to predict, because we just don't know what kind of economy is going to emerge from the rubble of those several years of restrictions. But nonetheless, I think on the other side, what you see is Musk talking about Twitter potentially approaching profitability sooner than he expected. He's on the other side of a legal challenge with regards to some tweets about taking Tesla private back in 2018. He was given a good judgment over the weekend and deemed not liable by a jury in San Francisco. So collectively, investors are seeing him potentially having fewer distractions, and therefore more time available to devote to Tesla's challenges. So even if you see the headwinds, maybe as an investor you feel better that Musk is likely and liable to be more focused on them than distracted by some of these other peripheral issues that really weighed on Tesla shares for most of last year.
I mean, the Twitter thing is still here, though, so maybe we do get some more attention to Tesla, but maybe we don't. Martin, I want to move on to our rapid fire segment, because there have been, and you talked about this slightly in the beginning, where we talked about the Dell 6,000 layoffs, but what's behind those?
This PC market is just in such a slump right now. We've seen it from Intel, from AMD, and pretty much everyone else that are describing what they imagine to be a pullback in consumer spending and just a very difficult comparable period, because we are not seeing the uptick in PC purchases that we did after the pandemic, because basically everybody has the machines now and hybrid work doesn't exist to the same degree that it did this time last year. So everybody's fully stocked and consumers are pulling back on spending. Not great news for PCs. Even Apple saw a significant decline in Mac sales over the December quarter. So no one is immune, and Dell is certainly not. They're going to have to cut jobs as a result in order to get their arms around costs. That will probably mean about 5% of the global workforce, translates to about 6,600 positions, but it still probably isn't going to change the underlying dynamics in a very difficult part of the computer tech industry.
Where's the beef? Tyson Food stock slumped after Q1 earnings.
Really bad beef prices, but a great pun, I have to say. Beef prices down about 8.5% when you compare to last year, and that was even outpacing the decline in beef sales that Tyson reported as well. Tyson's an interesting company to me, Katherine. It's the biggest food producer in the world, and as a result, what they are seeing in terms of demand and prices are ultimately going to find their way onto the grocery store shelves and have enormous implications for food price inflation and indeed for CPI writ large. So I'm very interested with what they're saying with regards to forecasting. They're not looking for any kind of rebound anytime soon. That will certainly be good news, at least with respect to consumer prices at food stores, but not particularly great news for those who are invested in grocery store companies, because their margins are going to get squeezed at the same time. And of course, Tyson shares today are down about 5 to 6% as a result of this Q1 earnings miss and really muted Q2 earnings forecast.
Big box deal, Public Storage is bidding for smaller rival Life Storage.
I'm amazed, Catherine, at the prices and the sort of value that we're seeing in this potential deal. Public Storage is the biggest public storage space in the country, as its name implies. It's been trying to buy Life Storage for a couple of months now, but that company, its smaller rival, has been sort of rebuffing the attempts. Public Storage went hostile late last night and said they want to pay somewhere around the region of $129 per share for Life Storage in an all-stock deal. It would give the company enormous scale across the country as it's looking at declining demand as a result of people sort of not as mobile potentially, or indeed in changing situations as they were during the peak of the pandemic years. So Public Storage feels that it needs to have a little bit more scale again to do that sort of whole cost control thing. Life Storage, again, is pushing back a little bit. The last I saw, there was about a $7 or $8 gap between what Public Storage was willing to pay and where Life Storage was trading. So investors might feel that Public will have to come back with an even elevated price to get this deal done.
Martin Baccardax, thank you. That'll do it for The Street today. Stick with The Street for more on these and all the other major market stories that matter to you.